Good morning. It's me, Kenny Polcurry, your host of the party, and today is Thursday, December 30th, 2021, and there are less than 48 hours before we ring in the new year. And so what is it that you need to know? What's happening in the markets yesterday, today, and potentially tomorrow? So look, stocks continue to push higher and higher as investors and portfolio managers do some year-end window dressing. Oil back in the high 70s, on its way to 80 plus a barrel, right? So hold on. Treasuries now churning at 1.5%-ish, leaving many to wonder, why is this still happening? And consider building in some downside protection for January and February. And so what are we having for dinner tonight? We're going to try this version of pasta Faggioli, but we'll get to that in a few minutes. Okay, so good morning. Stocks are continuing to enjoy the after Christmas sale. The problem is, there wasn't a sale going on, right? Investors and traders and algos continue to take stocks higher and higher as the Santa rally continues. A rally that I was not sure was going to happen considering all the noise, right? Think Fed policy, potential new Fed members, a change in the FOMC members, inflation, interest rates, infections, legislative roadblocks, to name just a few. But guess what? It has happened. Just the same. And for investors who did not panic 3 weeks ago, they're enjoying these waning moments of 2021 as stock prices push higher and higher and then higher again. With the new year only 50 hours away, many are setting themselves up for what they believe will continue to be an economic rebound in 2022, all while newly diagnosed COVID cases reaches another daily record high. Yet none of this is causing the same panic that it did nearly 3 weeks ago. We're apparently becoming much more comfortable with this latest variant, acknowledging that while it may be more transmissible, it's not more deadly for the majority of the world's population that are vaccinated. And so, stocks around the globe continue to move higher. Right? It's really a fascinating phenomenon. By the end of the day yesterday, the Dow gained 90 points, the S&P's up another 7, the NASDAQ did give back 15 points, but look, it's risen 800 points in the last week. The Russell added 3 points, and the Dow Transports gained 75 points. Investors have been trying to put the Omicron breakout into perspective as governments and multinational companies around the world attempt to impose a new round of restrictions to try and slow the spread. New York, New Jersey, DC, and Maryland all experiencing a surge in new infections, and these are the most vaccinated and boosted states, which is causing some concern and really a lot of confusion for so many. Airlines continue to cancel flights at record levels amid staffing shortages, which leaves one to wonder if employees are really taking advantage of this latest surge. I mean, who is going to question you if you say you don't feel well? Apple, for one, has shuttered all of its New York City locations to shoppers as the virus continues to wreak havoc on the city. Interestingly, though, that they have not closed any other stores around the country. They've only closed the ones in New York City. Customers, though, are still able to pick up online orders and then pick up those orders outside on the sidewalks. Dramatic? Yes. But Apple qualifies their decision by saying that they regularly monitor conditions and will adjust both health measures and store services to support the well-being of customers and employees, right? That's great. All this as the CDC just lowered the quarantine requirement for those who are vaxxed and boosted. And studies show that the infection results in milder illnesses and lower risk of hospitalizations. The unvaxxed are the ones that remain at the highest risk, but they know this. They know this by now. That message has been hammered home over and over. So in the end, everyone makes their own decision, right? 10-year treasuries yesterday ended the day yielding 1.54%, which is still confusing considering that inflation is pushing nearly 7%, and the Fed has made it crystal clear that they're set to move in the new year. Bond experts tell us that the reason for this is that there is still a massive demand for U.S. treasuries from foreign sovereign states, insurance companies, pension plans, and of course the Fed, right? Others believe that the Fed is going to remain dovish no matter what they say, which is causing yields to remain low, as they continue to buy treasuries even as they tell us that they are paring back, right? So they're continuing to buy at least $90 billion in treasuries, but we'll see. Some even question if that's really the case. Whatever. Remember in January when January of 2021, when the CPI was only 1.4%, Treasury surged from 1.25 to 1.78 in 3 weeks on the anticipation that the Fed was going to start thinking about changing policy. Stocks took a swift hit. NASDAQ stocks sold off hard, with the index losing 12%. Individual names even more. The S&P gave back 6%. The Dow names gave up 4%. The Russell lost 10%. And today, contrast with that with today, inflation is running at nearly 7%, and stocks are kissing closer to their 2021 highs. So something has to give at some point, because remember the adage, stocks can remain irrational longer than you can remain solvent. Now, while the irrationality right now is to the upside, and that's good if you're invested, we know that this can't go on forever. And so it's about balancing out your portfolio for what is expected to be a turbulent time in the coming months. And let me be clear just once again, balancing out your portfolio does not mean panic sell at all. It just means allocate new monies to sectors that are expected to do well in a rising rate environment, right? A rising rate inflationary environment that many street analysts and economists acknowledge will continue through 2022. And while the administration wants to tell us that inflationary pressures are going to subside by April, I say challenge. Recently, in fact, the Social Security Administration announced that they're raising monthly Social Security checks by 5.9% in 2022, the largest jump in 40 years. You know what 40 years ago was? Let me tell you, it was 1981. Inflation was running at 10.3%. So I'm just saying, you have to ask yourself, is the government really telling us something? We'll see. In any event, it is what it is, and you should prepare yourself for some turbulence in the months ahead. So maybe that means going along some names that will benefit if the indexes and thus the stocks get hit. So you should take a look at things like DOG, right, which is the ProShares Dow 30 short. Or SH, which is the ProShares S&P short. PSQ is the ProShares NASDAQ short. Or the VIXY, VIXY, which is the ProShares short-term VIX index ETF. And while there are so many other ways to hedge yourself, you have to start somewhere if this is all new to you. Adding these contra names to your current portfolio is going to help blunt any swift moves lower in the markets. Because it's not when, it's when and not if that move comes, right? Understand, though, that these names are not meant to be long-term holdings at all. They are considered more short-term in nature and need to be managed a bit more closely, which is why you should be talking to your advisor if you are concerned. Yesterday saw only 3 of the 11 S&P sectors lose ground. Financials, communications, and energy all gave back just a bit, but they remain up 33%, 16%, and 47% respectively. Healthcare, utilities, and staples led the way higher yesterday. The value trade was up 0.25%, while the growth trade was flat. Oil ended the day higher, up 60 cents at $76.59 a barrel, and this morning is churning right in line. Recall that oil came under fire when news of the new variant hit the tape 3 weeks ago, losing 25% over that time period as renewed talks of disaster permeated the psyche. Many telling us that Omicron would be the one to destroy demand, and traders and algos hit the sell button. Recall how I was not buying that argument at all, and I kept debunking it every morning. And where are we now? Well, we've regained the 25% that we lost, and we're now north of all 3 trend lines, right? Which is bullish, and we're heading back towards $80 a barrel. And as I told one of my Twitter followers who challenged me at every turn, screaming about how oil was set to collapse when it was trading at $64 a barrel, I said to him we were going to see 80 before we saw 60. And now we're just 4 points away from that target. Look, energy demand is not going away anytime soon, right? It just isn't. The move to renewables is underway, and that's good. But it's not happening in the new year or the year after that or the year after that. Capiche? So stick tight. Don't be so quick to toss energy out the door. By the way, lots of energy names are becoming renewable names. That's another conversation we'll have in the new year. Gold has been hugging all 3 trend lines at $1,800 an ounce and is poised to move up before it moves down significantly. It needs to pierce and hold $1,804 an ounce. That's less than $1 from where it is right now. If I'm wrong and it fails, then look for it to find support at $17.75-ish. U.S. futures are up again this morning as Santa makes his way across the globe, right? Dow futures up 45 points, S&Ps are up 8, the Nasdaq's up 32, and the Russell's flat. European markets are also all up across the board by about 0.25%, and Asian markets ended mixed, but nothing really to write home about, right? Nothing really, it's the end of the year. There's not a whole lot happening other than churn, right? We're in the final hours of trading for 2021. Lots of window dressing, tax loss harvesting, and rebalancing going on as portfolio managers try to doll up their holdings at the end of the marking period, which is 48 hours away. While many economists are adjusting, lowering their first quarter 2022 forecast for economic growth, investors do not appear to be concerned that this is going to disrupt the story yet, as money continues to pour into stocks. Look, I can't find anyone that thinks COVID or any of its derivatives is over or even going away anytime soon. It is now an endemic, no longer a pandemic. But what is clear is that investors are no longer allowing it to control their investment decisions, at least not yet, as they take stocks to new highs. Remember, at the end of the year like this, moves can be amplified during this week. Many participants have closed up shop for the week, leaving inline liquidity weaker than what it might normally be. Voids in price levels can force moves in either direction to be more exaggerated, and that's what I think is happening at the moment. But no matter, because it is what it is, and it is happening, and stocks are rising, and portfolios continue to benefit. So enjoy the ride while it lasts, because it's not going to continue like this forever. Let's just be clear about that. Bitcoin this morning is trading at 47,500, off a little bit, and Ethereum is trading at 3750, also a little bit lower. Again, I think just in some year-end tax selling and all that crap. Anyway, the S&P is kissing 4,800, and if you draw a trend line from February of 2021 to now, it suggests that we should hit resistance at 4,863 on the S&P, which is a 70-point move from about here. But again, it's a holiday week. Many are away from their desks. Much of the trading being done by algos. And so go with it and get ready to get back to work in January. Remember, investing is dynamic, not static. Pay attention and talk to your advisor if you're at all concerned. You can also text the word INVEST to 21,000 on your cell phone to get my digital business card. Feel free to text it, download it right into your contacts, send me off an email or a text, give me a call. I'm always happy to engage and talk markets, planning, thoughts, concerns, ideas, whatever's on your mind as we move from 2021 into 2022. Now look, you can follow me on Twitter and TikTok, at Kenny Polcari is my handle, and you can get me on Instagram at Kenny P. 1961. Okay, so what are we having for dinner tonight? I said it's a new twist on this pasta fagioli, right? Because pasta fagioli is typically a tomato sauce kind of a dish. This is not. This is pasta fagioli with pancetta and sweet Italian sausage. It's an easy dish to make. It's better if you make it, you let it sit overnight. But it's fine if you don't, right? But make a large pot, so then you do get some that sits overnight. Anyway, for this, you're going to need 1 can of cannelloni beans, sliced garlic, thick cut pancetta. You're going to cut it into small little cubes. Sweet Italian sausage that you've taken out of the casing. 1 large onion, thinly sliced. You're going to need olive oil, vegetable broth, or chicken broth, either or. You need a half a box of ditalini, which is that really, really tiny pasta. Salt and pepper, and some finely chopped parsley. And of course, you need fresh grated Parmesan cheese. Begin by slicing the garlic and sauteing in a pan until it's golden. Now add the pancetta and the onion and saute for another 10 minutes or so. Now add in the sausage you've taken out of the casing. Turn the heat up to high, stirring it and breaking up the sausage meat, right? It should all be done, cooked nice and brown through in about 10 minutes or so. Now you're gonna add the can of cannelloni beans, the water and all. Now add enough broth to cover the sausage and then some. Simmer it for 10 minutes. Taste it, season it with salt and pepper to adjust. Now turn the heat to high, bring it to a boil. Add the pasta. Do not add the whole box. Remember, the pasta will grow and suck up all the liquid. You don't want this to become dry, so keep your eyes on it as it's cooking. You want to keep the pasta in enough liquid to cook, and if it looks like it's sucking it all up, just add more of the broth. You want to keep it soupy but not wet, right? You want it to be soupy, not wet. Should be done in about 8 minutes, right? Then you want to ladle the soup into bowls, add some of the chopped parsley on top just to decorate it, and then dust it with some fresh grated Parmesan cheese before you serve it. And always have the extra cheese on the table for your guests, just in case they like more cheese. Because like me, I like cheese in my soup. One way or the other. Look, it's a beautiful day outside. It was a beautiful day yesterday. It's going to be a beautiful day today. And it's going to be a beautiful weekend here in South Florida. So in any event, the day is young. Get started. Take good care. And I'll see you in the morning.